Welcome to the Daily Brief, where I'll go over the action in the market for Monday, January 30th, and then we'll see how things are looking for Tuesday, January 31st. We saw a little bit of weakness today. The S&P was down 1.3%. We started to see some weakness develop last Friday going into the close, and that pretty much carried through into Monday's session. And we really have to wonder now. The market's had a pretty good run up. Are we starting to see some weakness develop? This is a very important week for the markets. We have a lot of economic reports coming out. The FOMC getting together, and they'll be making their announcement. The important part of that is going to be the press conference after they make their announcement to see if Jerome Powell gets more hawkish or remains a little bit more dovish. The market's been going higher with this idea that the Fed will be able to slow down their rate increases, if not get close to pausing. As the market's been going up, we really haven't heard all that much coming from Jerome Powell about what's happening. Well, is he going to say something at the press conference on Wednesday that's really going to spook the markets and have everything start to go down? Or is he going to remain a little more friendly while the market continues to go up? Let's go back and talk about what happened. Right at the open, we did have a gap lower open with prices opening right down at S1. That was at 4,048. There was an attempt at a bounce, but it was unsuccessful. As the day went on, prices fell back through S1 again and spent the rest of the day drifting lower. Prices kept falling down to S2 at 4,026, and we ended up closing at the low. We were down 1.3%, and we were below average in volume. The idea that volume was below average could be taken as positive. On a down day, volume is actually going down. That just shows that there's not an awful lot of conviction behind the selling. The fixation is that the technicals are still positive, but you gotta wonder if we're not starting to see some weakness. And I asked that question throughout this whole video. Inflation and interest rates are really what's driving the market right now. That's bleeding through into growth concerns, both inside the US and worldwide, because then that feeds over into the earnings per share, or EPS, as well as the valuation concerns, whether we're overvalued, undervalued, or fairly valued. The geopolitical concerns, not really hearing too much as it applies to the market. Germany and the U.S. have agreed to supply tanks to Ukraine, and that may produce some kind of an escalation by Russia. We have earnings coming out. There's a lot of companies that'll be coming out. It's well over 100 this week. And then the debt ceiling, which I'm not really hearing anything about as it applies to the stock market. There's a lot of political finger pointing going back and forth. And everybody has the answer and blaming the other side, which is typical for politics, but nothing seems to really be getting resolved. Let's go back and look at the action in the market where we gapped lower, and then we saw a bit of a recovery bounce here, but that didn't last very long. We came down to S1, bounced up, then we broke down through S1. What had been support now became resistance. We came back up to S1. We were not able to go higher. So then we spent the rest of the day going down. We ended up going through S2, saw a little bit of a jockey of prices going into the close, and then closed pretty much right at the low. So what are some comments that we can make? Is the market starting to roll over? Not saying that it is. It's just when you look at the chart, it's looking a little scary right now, and it looks very vulnerable. The Fed, the European Central Bank, and the Bank of England will all be making rate decisions this week, so they can have an impact not only on U.S. markets, but European markets as well. There's real anticipation about Fed Chair Powell's press conference and that he may remain more hawkish. He's taken an officially hawkish stance, but as the market's been going up, he hasn't said anything to kind of cool things down. That's why I say maybe he'll remain hawkish. Then we had another article by Nick Timiraos. I have no idea if I'm pronouncing it right. He's a writer for the Wall Street Journal. We've been dealing a lot with his articles. Over the weekend, he posted an article. He's talking about Fed officials that they're concerned that inflation could reaccelerate. That's starting to come into the picture now. Inflation has been coming down. Is it going to start to go back up? And this mainly is due to the tight labor markets. And then on Monday, he came out with another article that said that the Fed's interest rate strategy could depend on how much the members in the FOMC believe the economy will slow. They discuss these things, then they vote on it, then there's the minutes that'll be released 3 weeks from now. There's a lot of variables out there. Recent areas of strength showed a lot of weakness on Monday. Over 100 companies will be reporting earnings this week. Growth underperformed value. It had been really outperforming since the beginning of the year, whereas it really underperformed in Monday's session. The NASDAQ and the NASDAQ 100 fell back below their 200-day simple moving averages. We're still a little bit overbought with the stochastics, and that's what we're trying to figure out now. We were getting extreme positive. We had a decline in Monday's session. It worked off most of the overbought conditions that we have. There's a few little leftovers here. But is this just a pullback after a good run-up, or are we really starting to see a shift over to something more negative? You can make a case for either side. Then in the long term, we still have the moving average study that's still a little extreme positive. Notice that there are no intermediate term signals here. The dollar was up and interest rates were also up, and then copper is holding on to its gains. I have a chart later on in the video where I'll talk a little bit more about copper. The 30 to the 5-year has gone back inverted again, where our other spreads from the 10 to the 5, the 10 to the 2, and the 10 to the 3 month, they still remain inverted. Sentiment is still positive. It had been at 69 and it dropped down to 67. We didn't have any economic reports that came out in Monday's session. In our trend, it's still positive. We're barely above that moving average. Both of them are really going sideways right now. So we say that it's a strengthening trend as long as it's above that moving average. But we are still below 20. Our bias is negative with the down day. And I've switched our momentum back over to mixed. We had a good week last week. But the late day weakness on Friday and then the weakness on Monday is kind of shifting things around. So I'm switching it over to mixed. Another thing that I talk about more when I'm dealing with options in my class and things like that is a thing called implied volatility. The takeaway from this chart, without getting too far into that, is when the S&P 500 is going up, volatility has a tendency to go down, kind of like the VIX. When the S&P is going down, implied volatility really picks up. So they have a pretty strong inverse relationship with each other. But if you look over here on the right in this circled area, we see both of them going up together. What's going to need to happen here? And then at the bottom, I add some text. Will adjustments to this relationship lead to a decline? It could be that implied volatility cools down and the S&P is able to go back up. Or implied volatility stays high. It could be that the S&P starts to decline. Another thing to look at are high beta stocks. These are stocks that tend to outperform the market either on the upside or on the downside. So when we're going up, folks like to be in those stocks. But when we're going down, they go down a lot faster and folks don't like to be in them as much. This is taking a ratio of the high beta stocks ETF to the S&P 500 equal weight. Now, I haven't talked a lot about the equal weight in the last year or so as the market's been dashing around. I have a number of equal weight charts, but I haven't really been showing them because I don't feel like they're giving us really any insight. Well, we're coming into a phase now where the equal weight charts may be starting to help us. One thing that we look at is when this is going up, that's what we call a risk-on environment. That's when people are getting into stocks and usually getting out of bonds, or at least not investing in bonds. And that's where you see the blue lines. When we get into a more difficult environment, that's called risk off, where people are getting out of stocks, so stocks are going down, and generally getting them into bonds because they're considered to be a lot less risky. And you can see over time, just going back the last few years, when we've gone up, that's a risk on environment. When we've gone down, that is a risk off environment. Look at where we're at here. We've been really coming down in more of a risk-off type of a situation, which really hasn't helped bonds all that much going into the end of 2022, even though they're starting to recuperate. But lately, I don't have a blue line here, but we've really been going up in more of a risk-on type of posture. If this keeps going up, that could also give some support to stocks. If we turn and start to go down, that could really signal that we might be getting ready to switch to more of a downtrend. Another chart is the economic fear gauge. When this gauge is going up, that means that there's a lot of fear. So look at this like you would the VIX. When it's coming down, that means that there is decreasing fear. From 2021 through 2022 and even up to the present day, even though it seems like things are going crazy right now, we've really been decreasing in fear overall. And this measures a ratio between shorter term bonds, usually the shorter maturities, and the S&P 500 equal weight. So this is another use that I found for the equal weight chart. We're not really in a high fear environment right now, according to this chart. And of course, in a short-term basis, the VIX is so low that it's suggesting that we're not showing a lot of fear either. Another thing to look at are the shorter bond maturities and take a ratio with investment-grade bonds. This also suggests that economic fear increases and decreases with the chart. So as we're going down, that means there's less fear. As we're going up, that means there's more fear. We've been coming down lately, and so there is less fear overall, and we're starting to turn back up, but we're not showing much of an advance, at least yet. So I'm just going to keep an eye on these charts, see if they help us on a day in and day out basis, and then as they tell us something, I'll be sharing that in the daily brief. The Ulster Index also suggests that there's not a lot of fear in the market right now. We're below the moving average and pretty much going sideways, even though it just curled up a little bit after Monday's session. Here's the VIX. We're trying to make our way back above 20 on a closing basis, but still, fear is very, very low. And then on the bar chart, we actually gapped up higher, but still, overall, the VIX is giving us a very low reading. When the VIX is low, it's time to go, and that's what people are starting to focus on. This is kind of interesting, though. Where the VIX has been going down, the VIX of the VIX is starting to go back up, so this is producing more volatility, and this is more of the implied volatility that I was talking about in that other chart. To see this going up with the VIX going down and the S&P going up, they're getting out of balance with each other, and so some kind of an adjustment is going to need to happen. Either the VIX is going to have to turn back down with its volatility, or the S&P is going to have to go down to get these things more aligned with each other. Our trend is pretty much sideways. It came down a little bit, but we're still above the moving average, and the green line is still on top, but we're still well below 20. Here's the daily chart. I just have the one daily chart to show you this time. This is where we're looking a bit vulnerable. We came right up just about to the December highs, and now we've been coming back down. Now, things could turn around and go back up, but to see us come right up to this point and then have a pretty significant down day, that just kind of leaves us out there hanging right now. We're still above this trend line, so that's positive. And we're also still above the 200-day and 50-day moving averages. We're going to be watching it as the week goes on to see, can we get back up and go back above this level, or are we going to break down below the moving averages as well as the trend line? Then at the bottom, you can see where volume was below average. Here's our stochastics. We're not extreme on the short term. We're still extreme in the intermediate term, and we're starting to become extreme in the longer term stochastic chart. All of our oscillators are still going up, but the slope, and I mentioned this in the video over the weekend, where it's starting to roll over. Well, after Monday's session, it's rolling over even more. The Stoch RSI is no longer extreme, nor is the Williams percent R. The rate of change going back 20 periods, it just ticked into extreme positive territory and has now come back down. The bullish percent index so far has been holding up. To have a decline of over 1% and see the BPI holding up, that could be taken as more positive. And then here's another look at that. I showed this in the video over the weekend. Instead of just looking at the BPI for the S&P 500, this is plotting the NYSE bullish percent index. And we're starting to break out a little bit here. That could be positive on a broader scale. Chaikin money flow did decline, but is still positive. And the CCI 14 as well as the CCI 20 are no longer extreme positive. The Chaikin oscillator also coming down after getting somewhat into extreme positive territory. Ultimate oscillator turned back down. And the TTM squeeze, this is another little more negative sign where we had been going up. The red had been shaded and it kept going up. We've rolled over a little bit, and now on the blue side, this blue is starting to turn darker, and that usually is more negative. Volume really decreased in Monday's session since we were below average. Our short-term fib levels were coming back down to the 61.8% retracement at about 4,006. We closed at 4,017, so we're still above that, but we want to be watching this if the S&P continues to fall. Longer term, we're coming back down to the 40-20 level. We have been able to break above that. Now we're coming back down and we're just a few points below it. The Swinland trading oscillator based on price and volume are now starting to turn down, but they're both still above zero, so it's positive with a negative flare. We're still above all the moving averages in our moving average tree, but if we see further declines, that could be in jeopardy. Or are we going to be able to bounce back up from here and have the moving average tree show a little bit more improvement? The Elder Impulse system for the S&P has now switched back to neutral. We're just a little bit below zero with the McClellan oscillator, so our summation index is rolling over a bit based on price, already rolled over based on volume. And sometimes the volume part of this indicator can give us a lead as to what's happening. New highs, new lows. Holding up a little bit better than you would think after the decline that we saw. New highs are really coming down. We're trying to break above this moving average, but we're pretty much going sideways. And we're also going sideways with the 10-day differential. Copy curve, we're working off of a signal generated in early January. This may be getting ready to cross. That means just the buy signal has gone away. And here's the longer term chart showing our 150 simple moving average is just coming down from being extreme positive, but the 200-day, it's turning down, but it never got to an extreme reading. The diamonds, which are the ETF based on the Dow, have switched back to neutral. Here's the NASDAQ, where we were able to get back above the 200-day simple moving average. Well, now we've come back down below that. And this is what I pointed out for Friday's video, but then we just blasted right through it. Well, now we're starting to come back, and we're going to have to turn around and go back up if we can, or is this going to be the start of some follow-through weakness? And we can say pretty much the same thing for the NASDAQ 100. The Qs, which are the ETF based on the NASDAQ 100, have also switched back to neutral. Here's the home builders. Not a lot to see in this chart, where it looks like the S&P is breaking out on the top, and home builders were down a little bit, just as the S&P was. And we're kind of showing a little bit of a divergence here. Could be a negative divergence. And then we're seeing the relationship between the two start to get a little bit more towards neutral, rather than having a tendency to go in the same direction. Another new chart is just a variation of the new highs minus the new lows. This is a 50-period exponential moving average. The new highs and new lows are plotted on here, and then I turn it to invisible, and the only thing you see left is the moving average. When we're in this upper area that's kind of a greenish blue, that's more positive, and you can see where the S&P was going up. When we drop down below this line, that's more negative, and this is when the S&P is going down. Well, we spent 2020 and 2021 up in this nice blue area. Well, in 2022, we broke down into this red area, but now we've been starting to bounce back up. I haven't put a color in here yet, but we're just starting to see at other times when we broke back up, we can look at the S&P 500, and a lot of times that gave support to the S&P. So this right now is looking positive. We'll just have to see if we're going to get some follow-through based on price. Another variation of this, the new highs minus the new lows, and I just have the color-coded areas. You can see the moving average plotted on here. I just took the color, and wherever the moving average was, that's how I color-coded these different areas. When we're more positive, we want to be above this zero line. When it's more negative, we drop below the zero line. And you see way over on the right, we're above the zero line, but can we stay above it? Another thing, and I even tried to practice the name Schiff Capital. It's a video that I like to watch every week. Get some interesting insight for that. It's freely available on YouTube. It's also one of the channels that I recommend on my YouTube channel. The NYSE Breadth Thrust. When we go really extreme negative, and we did in 87, 1990, 1998, 2008, we did it back in October of 2022, and then we come up out of that. What are the returns like? A lot of times when we get these readings, that means a washout for the S&P. Thanks to Schiff Capital, again, I don't know if I'm saying that right, in 1987, 1990, 1998, 2008, if you're looking out from the time this signal was generated that you see on the chart, what were the returns like 1 year, 2 year, and 3 years going into the future? And the interesting thing about this is there was never a losing record based on this. We bottomed in October 2022. We're starting to come back up now. And based on historical precedents, that should bode well for the S&P 500. We don't know for sure if this is going to happen or not. There's always, this time is different to the negative side. Just based on some research here, it may give us a little bit more confidence going forward with the S&P 500. And it may help to explain some of the strength that we've been seeing in the early part of 2023. Doesn't mean we go straight up. And there are some pretty significant downturns when these things happen. In the bigger picture, it could be switching things to a more positive picture. Another chart, this is just a variation of one of our possible positive scenarios where we have the percent of stocks that are above their 200-day simple moving average. I have this all marked up here. Well, what the Shivaco Capital did over the weekend, they actually gave some statistics. I don't go back. I go more based on what I see on the chart and then go, oh, wow, look at what the S&P did. Well, he ended up doing some actual number crunching here and looking out 1, 2, 3, 4, 5 years. And you can just see the returns where the average return was 13%, the median's 15.37, and they were positive 80% of the time. But going forward from there, they have pretty much a perfect track record. Now, we never got down to a real extreme negative reading. It was extreme, but it wasn't as extreme as some of these other readings that we've seen. This also could bode well to the bigger picture for the S&P 500. Copper, another thing that's starting to go up. And if the economy is getting ready to fall off a cliff, why is copper going up and giving us a recent golden cross? Another interesting thing from Michael J. Kramer that I found, the white line here is copper, pretty much is showing what I just showed you on that chart. And the blue line is ISM manufacturing. And we will be getting that reading this week, where these tend to go in the same overall direction, either up or down. Well, look at what's happening way over here on the right. You've got copper going up and ISM manufacturing going down. Is copper going to turn and start to go back down? Or are we going to see some improvement in the economy with the ISM starting to turn back up? So that could make this report that's coming out this week a lot more important. So what's our outlook for Tuesday? We have some major economic releases that are coming out. On Tuesday, we have the fourth quarter employment cost index, ISM releases both on Wednesday and Friday that I just alluded to. The employment situation report, that's going to be a big one because that's kind of the real big albatross around interest rates right now, is that the economy may be really slowing down, but the employment situation is not. And so we're going to be really focused on that report. The technicals are positive and we're still above that long-term resistance, but I'm having to ask this question, is weakness beginning? If we see follow-through price action, and once we were able to work off this short and even slightly intermediate term overbought situation and now start going back up, okay, no, weakness is not developing. But seeing the vulnerability, especially of that NASDAQ chart, and then looking at the S&P chart that's also looking a bit vulnerable right now, this could suggest that we might be getting ready to see some weakness. The economic reports coming out on Tuesday, the Chicago PMI, the fourth quarter employment cost index, the FHFA housing price index, the S&P Case-Shiller home price index, and consumer confidence. And then the whole list of geopolitical events. The big ones now are the Fed, what they're going to say after Wednesday's meeting. We're pretty much sure that they're going to raise interest rates 0.25%. But then what is Chairperson Powell going to say in the press conference? Keeping an eye on the Russia-Ukraine situation, just in case that escalates as far as the stock market is concerned. And then earnings will be coming out. And then if we hear anything about the debt ceiling and that actually getting solved. Looking at the statistics for January 31st, not very good. For the Dow, the S&P, and the NASDAQ were under 50% with a neutral to negative slant at best, where the Dow is actually negative. And then we're coming up to the end of January. After the trading session on Tuesday, I'll be able to update the January barometer and then give you some insight based on the Stock Traders Almanac. Then we're still in that 3-month window for the quarter, the November, December, January. It's a quarter of a year, but it's technically not a quarter. And then we're waiting to see, are we going to have a 2-to-1 reading? It's probably going to be 3-0. S&P 500 is going to have to fall an awful lot in Tuesday's session to close down for the month of January. And then, of course, the market likes that we're split between Republican and Democrat. All right, our scenarios, the down one, but the technicals are still positive overall, and we're still above that trend line, and we're not trending right now. Can't really go with the up scenario either because we might be getting into some weakness. Our scenarios and our rotation and our setups, they took a hit on Monday. They're still hanging in there. We could still recoup some of those. That's why I didn't show any charts, because they didn't really show us any strength in Monday's session. And we're dealing with pivot levels, fib retracements, and areas of support and resistance. So we're still going with the sideways trend overall. Even though the ADX is strengthening, it's just barely above that moving average, but it's still below 20. The green line's on top, so it's positive. Our conclusion, the S&P is positive, above the trend line, but weakness may be starting. There, I said it for the third or fourth time. In the short term, we're positive, but we're showing some weakness in the short term. Not really seeing it yet in the intermediate term, so we're still overall positive. Long term, as long as we stay above the 200-day simple moving average, we can remain with more of a positive slant. Thank you. I hope you have a wonderful day on Tuesday. Be watching things. There's a lot happening this week. Could be real pivotal to the short to intermediate term of the S&P 500. Have a great day, and I will talk to you in the next video.